A few weeks ago, I did a live stream with TD Bank for their Investor Education Month. In this live stream, I went through my investment thesis on Constellation software, and I was asked many great questions about my research process and the business. Unfortunately, the live stream had technical difficulties which caused it to cut out and not be shown. So now I am posting it as a video on my channel so that everyone can see it. Working with TD is a great opportunity, and it only felt right to post the video since the live stream didn't work. I know this isn't my typical video post, but I'd love it if you would like the video and give it a watch. So with that being said, here is the live stream.
What's one of the keys to picking winning stocks? Well, is it getting hot tips from randoms on Reddit? No. Is it following the screaming man on television? No. Is it taking your hands off the wheel and letting your favorite pet decide what stock you should pick? That's adorable, but no. The secret is research grounded in facts and fundamentals, not hope. And that's what DIY investor Daniel Pronk is all about. So let's hear this seasoned stock picker's process for finding his best investment ever and how it might help you do the same. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. Investor Education Month is in full swing here at TD Direct Investing, and we're glad to have you along for the ride. We're helping you turn small steps into big opportunities in your financial life. And of course, striking it rich on a winning stock pick is certainly one way to help reach your goals. And having a thoughtful process in place can help boost your chances of making that happen. So let's get one investor's step-by-step guide to doing so. Joining us is DIY investor Daniel Pronk. He shares his approach to picking stocks to over 270,000 subscribers on YouTube. And he's also the author of the book, The Fundamentals of Investing. Daniel, great to have you back on the program with us. Always great to chat with you.
Yeah, thank you for having me back. It's always great to chat.
Now, of course, Daniel, you're a full-time stock picker these days. You're scouring the market for the next big thing. I'm curious, what percentage of stocks that you actually start looking into and research would you say that you ultimately end up investing in?
Yeah, that is an interesting question. So I probably at this point, I've looked at thousands of stocks over the years, and I've maybe invested in 30 over that same time frame. So whatever percentage that is, it's well below 1%, I think. So I look at a lot of stuff, but I am extremely selective and picky with what I actually will put my money into.
Yeah, that's like, talk about finding needles in a haystack. You're like shoveling out a bunch of hay as you get there and just trying to pick these really, hidden gems, so to speak. It sounds like a really involved process, just given how many stocks are out there. I'm curious how much time you're generally spending sifting through all this research before ultimately making the call on whether investing in a stock or not.
Yeah, that really depends on the business. Like, some business models are extremely easy for me to understand. Like, for example, there's a business here in Canada where they buy apartment buildings. They take the cash flow from those apartment buildings and then go and buy more. That's a very easy business model for me to understand. So with that one, I would be okay to go from the research to putting my money in within a day. But if a business is more complicated, something like an industrial conglomerate or like a worldwide business that has operations everywhere, definitely takes a little bit longer. But yeah, I'm happy to go from the start of the research process to investing within a day if I like what I see.
If you had to put a number on like the amount of hours that you're generally putting on these investments, like, could you ballpark it for us?
Well, I typically continue my research over time. So I'll initially buy a position in a stock if I'm interested, and then continue buying more as I continue researching it and liking what I'm seeing, hopefully. But the total amount of time that I do before making the initial purchase could be, anywhere between 4 hours to 6 hours, like within a day's work.
Okay. So all in a day's work then. Let's hear about one of your best investments that you've made and that research process that helped you ultimately decide to invest in it. And for those in our audience, if you want to get in on this conversation, you have questions for Daniel, I'm sure you do, make sure you submit them to us. If you're watching on Webroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, you can use the questions and comments box. And if you're watching on our YouTube live stream, just click on the link in the description. It's going to take you over to the broadcast platform, and that's where you can ask your question. Okay, Daniel, so, don't leave us in suspense here. What is this best stock that you've made to date that you invested in, and how much have you earned on it?
Yeah, so we'll talk about percentages. The best stock, it's best for a few reasons, but It's Constellation Software. It's a fantastic Canadian business. It's been an incredible compounder in the market. Absolutely has dominated the S&P 500. On my position right now, I am up roughly 100% over the past 3 years, which may not be as exciting as what you see on social media today. But part of the reason why I call it my best investment ever is because I believe it is pretty much the ideal business. It has the most ridiculous metrics I've ever seen, and it's just been a fantastic winner over the long term. I actually found this one a little bit late. I had my initial purchase in 2022. But if you take a look at the long-term track record of this business and its share price, it has been phenomenal.
I mean, hey, listen, 100% gain in 3 years. That's some pretty tidy work, all things considered, right? I mean, yeah, we're not going to the moon, but I mean, hey, we're hitting some stars, right? I think that's pretty good. So let's go through this research process that brought you to the point where you invested in Constellation Software. We'll use Constellation as an example throughout this as you explain the process to us. That first step, of course, is to find a stock that's worth investigating further. How did Constellation Software end up on your radar? You said you caught it a little bit late. How did it get on your radar?
Yeah, so my story with Constellation is kind of funny. I actually found it on social media. At the time, it was Twitter, I believe, but I found it on X. So I have a few investors that I have come to trust and respect on the platform. And many of them were praising Constellation Software. And at this time, for some reason, I've never heard about the business. So when I see that a lot of people that I respect and think are good investors talking about one business, it's typically a good idea for me to take a look as well. So that's how I discovered it.
Okay, and then are there other ways that you find that you come across stocks that are worthwhile if it's not through social media?
Yes, absolutely. I also use stock screeners. That is, I would consider, or say, like my organic way of finding stocks. It's typically how I find the majority of my investments, is screening for stocks and using filters that I look for in businesses.
Right. Okay. So yeah, running an initial screen and stuff like that. I mean, social media, to your point, it can be partly an initial screen if you trust the source. That said, some of the quality of insight on social media, I think you could generously describe it as a mixed bag. So how do you tell if a source is credible or not? Like, you know, in the examples that you gave of some of the folks that you like to follow, what made them stand out to you in a way where you even trust the idea that they're putting in front of you?
Yeah. So the number one thing that I look for whenever I'm looking at any investor is their long-term track record. I think that's the best indicator that they know what they're doing. And by long-term, I mean, it would be ideal to see a track record of over 5 years, because in the short term, as we've seen over the past couple of years, pretty much any stock can go up a lot very rapidly, and fundamentals can kind of be thrown out the window in the short term. So I think that looking at someone's short-term track record is not a good indication of how good they actually are as an investor. So I prefer to look at the long-term track record. And then additionally, if I notice that someone on social media, or even, you know, just like an investor in a blog or something, is sharing their portfolio, and I notice that they have some of the similar stocks or a few similar stocks that I have in my own portfolio, then that can suggest that maybe they look for the same things that I look for in a business, and they're trying to focus on the same key qualities of a business in their own portfolio. And then that can give me an indicator that maybe I should take a look at everything else they own, because those other stocks or businesses may have the same qualities as well.
Yeah, certainly. Anybody can get lucky in the short term, if you want to put it that way. But yeah, that track record, to your point, yeah, it makes good sense to follow up on that. Okay, let's get to the second step in your research process, and this is to scan the company's financial statements for some immediate red flags. Rather than, again, like we were saying earlier, trying to find the needle in a massive haystack, let's get rid of some of the hay. So, like, what are some of those warning signs that you don't want to see?
Yeah, so some warning signs for me are low growth or no growth to revenues and profits. Also, low profit margins would be a red flag, not necessarily on its own, but that is something that I pay attention to. A business that is over leveraged, so has a lot of debt on their balance sheet. And then the ultimate red flag for me is if a business's share count is going up rapidly. And typically, if the share count is growing by over 5% per year, that starts to raise a red flag for me. It's not an immediate no, but it is something that I need to investigate more. But if the share count is growing by something like 10 to 20% per year, it's almost a write-off for me. I think that is a signal that the management is not trying to protect shareholder value, because they're so willing to dilute their shareholders. So high share issuance is my number one red flag.
Right. I mean, the more shares on the market, that means the less for You who hold some shares, right? You're getting the pie divvied up among more people at the table, right? Nobody likes that. So then tell us, using Constellation Software, then what stood out about their financial statements that you liked?
Yeah, Constellation Software. Like, if you ever want to see Daniel Pronk's ideal business, go and take a look at Constellation Software. This business has been growing its revenue by over 20% since it IPO'd in 2005, so 20 years straight now. Cash flows have also been growing by over 20% per year, and the share count, they have not issued a single share over that period. So this company, I believe that they have proven that they know how to grow a business, create shareholder value, increase the profits per share, and really respect the public shareholders of their business.
Yeah, those are some pretty juicy metrics. I mean, of course, this is historical performance. We don't know what's going to happen in the future, but a pretty lengthy track record that can certainly be appealing, and certainly was in your view. So let's talk then about the third step in your research process, and this is to learn about the company's business prospects and its management team. You know, once it's sort of passed those initial screens for you, you know it's not a total piece of junk, at least in your criteria. How do you like to do this?
Yeah, so analyzing the management is kind of nuanced. There's not really too many, metrics that are like, yes, no, the management is good. You do kind of have to use your gut and try and weed through what they're saying. So what I like to do is go through their investor presentations if they have them. Constellation Software actually does not have any investor presentations, but they do have shareholder letters. So I try to find the data and the information that the management has given the public on the business. So again, for Constellation, that would be in their shareholder letters. And then I try to read through them and just see how focused are they on creating shareholder value? Are they saying the right things, or are they trying to hype up the stock and just get, the market and investors excited about their stock? So it's really just kind of like a litmus test between, are they being honest? Do they have high integrity? Are they trying to grow shareholder value? Or are they just trying to create hype and get you to buy into the stock?
What are some of the things that you need to see in an investor presentation that makes it clear to you that it's not just empty hype and marketing fluff and stuff like that? Is there anything that you really need to see?
I like to see a management team that is focused on per share profit growth, because ultimately per share profit growth is what creates shareholder value and causes stocks to rise over the long term. So I really like to see a focus on per share profits, whether that's earnings per share or free cash flow per share. Then I also like to see the management, if they have an investor presentation and they're giving an outlook for what they're expecting the business to do over the next 3 to 5 years. I'll take a look at that. I'll consider it. But what I really like to do is go and take a look at their historical material. So let's go 5 years back to 2020. Let's see what the management was saying 5 years ago. What were the projections they were giving the market and their investors? And then how did those actually play out in reality? Did they hit their projections? Did they meet their targets? Or did they massively miss them? And I like to do that over long periods of times. I'm kind of a nerd, so I will go through like literally every investor presentation and take a look at this. But yeah, I think that having a management team that has consistently outperformed their own guidance and have been honest with shareholders gives me a lot more confidence in the management team.
Hey, listen, it's not nerdy to like to do some investor presentation reading by the bedside there, whatever, at night. It's great material, great material. So in Constellation Software's case there, what stood out to you again after reading some of their investor materials, those shareholder letters?
Absolutely. So one of the things that Constellation Software that really stood out to me was their focus on free cash flow per share growth. They made it very clear that that is the metric that matters. Mark Leonard, who is the CEO of Constellation Software, actually wrote in one of his letters a while ago, I guess he's not the CEO anymore, but we'll talk about that later. But he wrote in his shareholder letter that it is not an achievement for a business to double its free cash flow if its share count also doubles. Because in that scenario, the free cash flow per share has not actually grown and no shareholder value has been created. That is a clear indicator that the person leading this business knows what he is focusing on and understands that per share profit growth is the pinnacle of what actually creates shareholder value over the long term. Additionally, the management of Constellation Software, it is required that they invest 75% of their annual cash bonuses into buying shares of Constellation on the open market, and they have to hold it for at least 5 years. So that causes the people in charge of the business to become 100% aligned with the public shareholders, because they are becoming public shareholders themselves with cash that they earned and their own money that they have to invest. So they're not being gifted, free shares of the business or anything like that. They're actually taking their own cash that they worked for and investing it in the business, which incentivizes them to continue creating shareholder value. And then lastly, Mark Leonard, who at this point is a billionaire, multi-billionaire, and Constellation Software, I believe, is worth something like $80 billion on the market today. Up until a few years ago, he was still flying coach whenever he was going and trying to make deals, and he was staying in 3-star hotels. So this guy, a multi-billionaire, is still trying to protect shareholder value by not being egregious with spending the company's money and trying to save his shareholders money everywhere he possibly could. And he believed that having this type of leadership and leading by example is how you create the culture and really get everyone in the business thinking about how you can save shareholders an extra dollar and really maximize your margins. So overall, it's been incredible. Another quick point is he actually reduced his salary down to $0, I believe it was in 2019, and he took no more compensation from the company, and he wanted to be 100% paid or have his net worth grow with his existing shares. So the only way that his net worth grows now is if the stock goes up. He's not taking a salary or anything like that. I think that is the ultimate alignment with shareholders. And as I continue to learn more about him in the business, I was just blown away. It's quite literally the pinnacle of management, incentivizing and aligning with shareholders.
I don't know if it says something about me or maybe the state of travel these days, but the thing of all those that really stood out to me was the riding coach. It's uncomfortable. Everybody knows it who's been traveling anywhere. So I don't know, that kind of jumped out to me. But your point about having skin in the game, I think, is well taken here, because that's another example why somebody who has a lot of skin in the game in the management team would be more incentivized to do those types of things, right? What sort of level of, I guess, insider ownership do you typically like to see that tells you, okay, this person's got enough skin in the game, I can sort of trust that they're going to hopefully have shareholders' best interest in mind?
Yeah, so a lot of the answers when it comes to investing and analyzing businesses is it depends. It's really hard to set out just a flat limit because, for example, if you look at a business like Apple, multi-trillion-dollar company, if I say 5% insider ownership is what I like, that's extremely high on a multi-trillion-dollar business. That position would be worth hundreds of billions. So as the business gets smaller, I tend to like to see higher insider ownership. But typically around 5%. Like if I had to give a flat number, I do like to see at least 5% insider ownership. That typically tends to be around the point where I think that they're aligned enough with shareholders.
Okay. Appreciate, that rough guideline to consider. Now, of course, you kind of teased it there a little bit, but Mark Leonard, no longer the CEO of Constellation Software. This is quite a recent development. Maybe just take us through very quickly what happened there, and does that sort of change your thesis at all about investing in the company, staying invested in it?
Yeah, that seems to be one of the major topics online right now is around him leaving the business. He left for health concerns, to put it simply. So he unfortunately had to step down. He's still going to be involved with the business, but he doesn't have the capacity to run the day-to-day operations anymore. I personally am not very concerned about this because I believe that his leadership style and that culture that he has created is long-term now. It is embedded within the business throughout every organization and all of their subsidiaries. And I think that this has been proven through the spin-offs that Constellation Software has done with Topicus and Lumen. These are two publicly traded companies now that used to be inside of Constellation Software, but then they, spun them off. They're their own public businesses now. And these companies have their own management. They are not led by Mark Leonard, the former CEO of Constellation, and they have continued to perform incredibly well. Their fundamentals have grown actually faster than Constellation Software, and I believe their stocks may even be outperforming now as well. So I think that's a good indicator that the culture and management style that Mark Leonard used to create Constellation Software has been successfully passed down throughout the entire business now.
Yeah, culture is a very powerful thing, and it can be very sticky in a lot of cases in a good way. So thanks for sharing the research process to this point. We got a lot more to get to, Daniel, but before we do, I just want to let our viewers know, if you're not following TD Direct Investing on social media, you are missing out, okay? We're on YouTube, we're on Facebook, we're on Instagram. You got QR codes on the screen here that you can scan. You can get a ton of content designed to help build your investing knowledge there for you. And you can also get sneak peek at upcoming episodes that we have of Inside Investing and our other live programs. And of course, if you haven't already, make sure you check out Investor Education Month at TD. We've got a contest going on, and let me tell you, you are really going to like the prize. Let's hear more about it.
The Investor Education Contest, brought to you by TD Direct Investing, is officially live. Canadians can enter today for a chance to win a check for $7,000 and a 1-hour private educational session with a TD Direct Investing client education instructor. There are 3 ways to enter. Visit the TD Direct Investing Facebook page, click follow, then like the contest, post dated September 10th, 2025. Follow TD Direct Investing on Instagram and like the contest, post dated September 10th, 2025. Or attend a TD Direct Investing Investor Education Month workshop. Learn how to register at td.com/IEM. You can enter once using each method. The contest runs until October 31st, 2025. Scan the QR code for full contest rules and details.
$7,000, that could make a big difference in your investment in your next big stock. So make sure you check out that contest. Daniel, let's keep the train rolling. We got your 4th step in the research process, and that is to compare the company that you're considering to its key competitors. What are you hoping to find out?
Yes, when I'm comparing a business to its key competitors, I like to see which business is growing its free cash flows faster, ideally also taking a look at free cash flow per share or earnings per share. Basically trying to figure out which company is growing its profits per share at the fastest rate, which company has the highest profit margins, if one has more insider ownership or not, and if one has diluted its shareholders more or not. So like if one has, diluted its share count by 10 or 20% per year and the other one is not diluting at all, then that's a pretty clear indicator that maybe I should be more interested in the one that is not diluting its shareholders over time. So those are some key things that I look for when I'm taking a look at different businesses.
And these are things that wouldn't necessarily come up in your initial screen. You have to actually dig deeper into the financial statements to find some of this stuff?
Some of these metrics would pop up in the initial screen. So typically what I do is like when I'm screening, I will typically find the business that looks the most interesting. But then I also want to try and understand, why is this one more interesting than maybe its top competitors, and what is it doing differently that is allowing it to produce higher returns and grow at a faster rate. So I really just try to get down to the why, like why is this business actually winning over its competitors?
And that's not stuff that can be summarized in a singular number necessarily. You have to do a lot of digging and reading to kind of find the answers to some of those things, right?
Yeah, so the numbers tend to be an indicator that something is going on within that business that's either better or worse. So the numbers give you a guide, but then I try to understand, okay, well, why are these numbers the way they are, and what is actually causing them to be better or worse?
So this is like the secret sauce of the research process in some ways. This is where the magic really happens. Tell us, when you looked at Constellation Software versus some of its rivals, what did you discover?
Yeah, so when I was taking a look at Constellation Software, the largest competitor that I could find, or I guess the business that's the most similar to Constellation at the time, was a company called Roper Technologies. And when I was comparing these two businesses, what I found is Constellation Software had higher margins. They were growing their free cash flow per share at a much faster rate. The stock was performing much better because of that free cash flow per share growth over the long term. And the business was not issuing any shares, whereas Roper Technologies, they're not doing a ton of dilution, but their share count is growing over time, which is also causing the free cash flow per share to not grow as quickly. So when I was taking a look at these two businesses, Constellation just seemed like the one that was honestly kind of obviously better. It was growing faster, had higher margins, much more performance over the long term, and seemed to respect shareholders a little bit more by not diluting them at all.
And we just have a look at the gross margin head-to-head comparison for these two stocks. This looks like, at face value, one of the most boring charts that you could see, because it's just two horizontal lines more or less across the screen. But this is actually quite telling if you look at how much higher Constellation is than Roper in this example. Maybe talk us through why that is exactly.
Yeah, so Constellation's, I believe we're taking a look at the gross margin here. It's significantly higher than Roper's. That's just because Constellation, I believe, is a much more efficient business. The way that they have operated their company is to be extremely decentralized. You could think about them like a Berkshire Hathaway of software. So whenever they acquire a business, they'll offer them guidance and mentorship if they want it. But when they acquire a software company, they typically just let that software company continue running as its own business and leave it alone. And what this has actually led to, Constellation shares a chart. I wish I got this one for this interview. But as Constellation's business has grown and scaled up, their head office expenses has actually declined as a percentage of revenue because their head office hasn't really grown with the overall company. And therefore, the management expenses goes down and down and down as a percentage of revenue over time. So their expenses don't really grow with the overall company, and they have been able to scale profits extremely well because of that.
Now, speaking of gross margins, this is something that we heard about earlier this year with DIY investor Brian Feroldi from Long Term Mindset, who was on the show. He said if he had to boil things down to just one metric that he had to follow, he could only choose one. He felt that gross margin was the one to look at. Let's hear why.
And one reason that I think this is a big red flag if you see this number going down is it indicates that either the company is losing pricing power with consumers, so it's forced to lower prices in order to attract sales, or the company does not have purchasing power over its suppliers. So its suppliers are pushing in price increases and the company is not able to successfully pass those along to its consumers. In either scenario, if you see a company's the gross margin going down over time, that is definitely a red flag.
So, Daniel, do you agree? If you could only pick one, don't sit on the fence here for me. If you could only pick one, would you agree with what Brian is saying, that gross metric is the one to follow, or is there another one that jumps out to you?
I think that it's a very good one. I obviously take a look at a lot of metrics, but gross margin is a pretty important metric to take a look at. I believe Warren Buffett has actually said that it is very important to take a look at as well, because if the gross margin is declining, then it can suggest that the business is being disrupted by competitors or its competitive advantage or moat is declining. So yeah, it's very important to take a look at and consider.
Okay, so of course that wouldn't be the be-all, end-all, of course, of the research process, as we've been hearing, but something to pay attention to for sure, in your view. Let's get to the fifth step in your research process, and this is to consider a stock's valuation before deciding whether you're going to invest in it or not. Why is this so important to you? And I'm curious if there's a line in the sand that you're just not willing to cross, even if you really like the stock on a whole bunch of other fronts.
Yeah, so I think that one of the things that makes me stand out as an investor, especially in today's day and age, is I do actually focus heavily on valuation. I'm a very big stickler on how much I'm willing to pay for a business. Even if it's the most exciting, most attractive business in the world, I still want to make sure that I'm not overpaying for it. So for me, I typically, just based on my own history, I have found that I typically do not like to pay more than a 25 price to earnings ratio or price to free cash flow ratio for any stock. And that even goes for Constellation Software. I will not pay more than that, I have found.
So speaking of Constellation, then, how did the valuation at the time play into your investment decision?
Yeah, so when I first purchased my Constellation Software shares back in 2022, I believe that the price to free cash flow of the business was right around 22, funny enough, at that time. And I thought that was a very reasonable price for this business, and that is why I initially took my position in it. I thought that its quality was incredibly high. It was continuing to grow. And I thought that the 22 price to free cash flow, again, was just very fair.
And it met that line in the sand metric for you, so that makes sense. But I want to pick on something. You were speaking with me off camera, and you were talking about how you've made this initial investment in Constellation, and there wasn't a follow-up investment because, frankly, it just got too expensive. And last month, we were speaking with DIY investor Craig Stevens, and he was explaining why he thinks leaving some cash on the sidelines in what he called an opportunity fund can be a savvy move. Let's hear his rationale.
Cash is king, right? And you look at Warren Buffett's portfolio, he's got something like $350 billion in cash just sitting there waiting. Now, we shouldn't be acting like Buffett. He can do what he wants, but when things went sour, he had the cash to move. And if you don't have cash to take advantage of these price disparages where you might be able to get a discount on a specific asset that you're targeting, if you don't have cash, then you're not going to participate.
So, Daniel, my question to you is that my understanding is that you like to invest as much money as you have all the time and just constantly be investing, and you don't leave cash on the side. But if you had left cash on the side, you might have been able to invest more in Constellation Software, and it's ended up being your best investment. So I'm curious, why do you take that approach rather than doing what Craig is doing and having an opportunity fund sitting in the sideline there?
Yeah, so I think this goes back to my initial answer a while ago, where it just depends. I think that, having an opportunity fund depends on the investor and how much cash you have coming in. Like, for example, if you have absolutely zero cash coming in, then maybe you want to focus more on the timing of your buys and sells and having that cash set aside in case things do get truly cheap and we see a correction or something like that. But for myself, I think that trying to hold cash is a position. And if you're holding it to try and deploy it at opportune times, it's kind of like you trying to time the market, which is something that I just simply do not try to do. There's enough historical data that suggests that trying to time the market is kind of a waste of time, and it's actually in your best interest to just continue buying whenever you can and as consistently as you can. So yeah, I'm not really someone who tries to time the market or hold a bunch of cash on the side.
I appreciate you sharing your perspective on that. I know challenging you a little bit there on the process, but you're not the only one who says, hey, listen, just steadily invest and don't worry about the rest. It'll take care of itself. One last quick question for you here on your research process, and that's once you've made the investment decision, what sort of additional research are you doing to make sure that you want to stay invested in whatever stock you picked?
Yeah, so my investment strategy, and I think that all people who are trying to buy individual stocks, it shouldn't be buy and hold forever blindly. I think that it should be more along the lines of buy and verify. So what I do is I stay on top of my companies. I try to stay on top of their quarterly reports, annual reports, what's going on with the business, et cetera. Like, with the Mark Leonard thing, with Mark stepping down due to health reasons. So I try to stay on top of what's going on with the companies and make sure that their competitive advantages and their fundamentals are still sound, and that the investment thesis overall is still intact.
Mm-hmm. Yeah, it's you don't just set it and forget it, right? With individual stock picking, it does take the legwork, but to your point, you can get some pretty great investments if you do the work and you have some fortunate timing. So thank you so much, Daniel, for sharing your research process with us. I think it's a great jumping off point for people to consider in their own research process, and maybe gives them a framework to follow. So we have a lot of questions coming in for you, of course, no surprise there. We're going to get to that in just a moment, but before we do, I just want to bring in my colleague, Caitlin Cormier, because she's going to show us how to research stocks in WebBroker, keeping your research process in mind. Caitlin, welcome to the show. Always wonderful to have you with us.
Yeah, thanks so much, Rob. Always happy to be here.
So give us a sense of how an investor could screen for stocks with certain financial metrics in mind in WebBroker.
Yeah, absolutely. So even using the word screen specifically, so we have a tool within WebBroker that investors can use to really filter down everything on the market to specific criteria that they're looking for. So let's just hop into the platform, and I'm actually already within the screen. I'll show you how to get there. We're just going to click on research, come under the tools, and then click on screeners to get to this page. Once we are there, we're going to come under just screening specifically. And today, just to save a little time, I've done the Martha Stewart thing where I've actually, not insider trading, but I've done an actual screen here that I've saved that has some metrics that Daniel looks at as far as his stock picking. So I have price to cash flow, the PE ratio, and the EPS growth. So all I have to do is kind of click on those metrics, and I can go ahead and choose kind of specific criteria. So let's just put in like a 25 as a max here to the PE ratio. Let's do that below, kind of 25 and below. And for EPS, I can just say that I'd like it at least over 10. And then once I put in that criteria, I can just simply scroll down, and it's going to show me the stocks that meet that criteria. So as I can see here, price to cash flow, it's giving me that kind of information as to what the number is for this company. I can click on the company to get more information, add it to a watch list, have it be one of those thousands of companies that I choose to do a bit more research. But that's just one way to kind of take all those companies out there and filter them down a bit better.
I have to admit, I didn't have Martha Stewart catching strays on inside investing on my bingo card for 2025, but here we are. But let's move on to another thing here, because a big part of Daniel's process was looking at financial statements and digging into those. Where can you find those on WebBroker?
Yeah, fundamental information, of course, another piece of the puzzle. So going a little bit deeper, we're going to click on research again, but this time we're going to click on stocks. Now, I do have Constellation Software, something we've been talking about a lot this particular episode, already pulled up here. And then what I'm going to do is I'm just going to click on this fundamentals button. and financial statements, funny enough. So once I get here, of course, I can see both annualized and interim statements. I can see right now I'm on the income statement. I can just click on balance sheet and cash flow to flow through those different statements. And you can kind of collapse and expand the different areas of the spreadsheets in order to see different parts of those particular statements. And again, you have kind of that year over year information, so you can look for kind of certain trends and see how things are looking within those statements.
And really quick, Caitlin, if we want to do some comparison between stocks, how could we do that in Webroker? Get a snapshot and get our research jumped off from that perspective.
Yeah, absolutely. So peer comparison is one of the things that we can look at here, and exactly where we just were within the financial statements tab. Right to the left of that, we have a little button that says peer comparison. If we click there, it's going to show us our company and then the industry average as well as competitors, just to give you that sort of quick snapshot look of some of those fundamentals of that company versus its peers.
That's fantastic stuff. A great place to launch further research. Thank you for showing us the ropes, Caitlin. Always appreciate it. And we'll have to see you next week too, yeah.
We'll see you next week.
All right, that is Caitlin Cormier. She's our senior client education instructor here at TD Direct Investing. All right, Daniel, without further ado, let's open the floor. Let's take some questions from our viewers. You ready to hear what they want to know more about?
Absolutely. Let's do it.
All right, let's fire up this first one. I believe it's Martin coming to us with a question. What's the biggest lesson you've learned over the years in stock picking, something you wouldn't do anymore?
Oh boy, I've learned a lot of lessons. I would say the number one lesson is to try and not speculate as much, and really know and understand when I am speculating and not speculating. So I'm reading through Security Analysis right now. It's a fantastic book. I would actually say it's better than The Intelligent Investor after reading it. But one thing that they wrote is you can identify if you're speculating or not more easily by trying to understand how much of the company's future, how much of the investment thesis relies on the company's future working out. So for example, if you're buying a business and the entire investment thesis is, in 5 years, this business should work out. It should be much larger. It should have this product developed over the next 5 years, and therefore I want to buy into it. That can kind of be an indicator that you're speculating quite a bit. If you're buying a business or a stock and your entire investment strategy relies on something going right for that business in the future or far into the future. So I try to avoid doing that quite a bit in my portfolio now.
That's a fantastic insight, because I think a lot of people, especially with growth stocks, might be inclined to think, well, obviously certain things have to play out for this to be a worthwhile investment. So it's interesting to hear you say that you are looking sort of at the here and now and using that as the crux of the investment thesis. How much are you willing to project, I guess, in the future and have a business still make sense for you as an investment?
Yeah, that's a great question. So you obviously do want to think about the future of the business, and I do want to be investing in businesses where I believe that they're going to grow and become much more profitable in the future. What it comes down to for me is the price that I'm paying. And the reason why I said earlier on in the live stream that I do not like to pay more than a 25 multiple for a business is because a 25 multiple, if you inverse that and you find the yield, that's about a 4% cash flow or earnings yield on the purchase price. And that's my limit. And the reason I do that is because right now, risk-free investments like government bonds are offering about 4%. So if I start to buy businesses above that 25 price to free cash flow or price multiple level, which is equal to a 4% yield, then I'm starting to get into the realm of speculation where I'm buying that business's future growth. So another thing that Buffett said is the margin of safety removes you having to rely on the business's future growth. So I want to make sure that the price that I'm paying for the business today, relative to what the business is producing today, is acceptable. And I think that the yield, my going in yield, is also acceptable. And therefore, even if the business did not grow in the future, based on its current profits, I am still getting an acceptable yield on the investment. And then therefore, I'm also getting all future growth for, you could call it kind of free.
Really appreciate you diving into the details on that explanation. That was really apt. Let's move on to our next question. This one's coming to us from Diego. Diego wants to know, what tools do you use for your company research?
For my company research, I use an investment platform that I actually developed called Stock Unlock. So I use that for a lot of the in-depth screening that I do and whatnot. And then I also go to the company's investor presentations, as I have said, and really just go to their investor website, take a look at all the material, go through their financial statements, their SEC filings, shareholder letters, etc. And I can find a lot of information in those.
Right, so you're going right to the source. There's nothing more fun than leafing through the regulatory portals to find financial information, right? More bedtime reading for you. Let's check out our next question. This one coming to us from Shiv. Shiv wants to know, what is your take on the massive U.S. debt and its long-term outlook for the U.S. stock markets?
I do not think that I am the best person to answer this question. I mean, theoretically, if you continue raising debt levels forever, it's probably not an ideal thing. But I've also heard people, or I've seen people talking about being concerned about the US debt level for 40 to 50 years now, and it's been fine. So it may be a problem at some point in the future. When it becomes a problem, I have no idea. And yeah, I just have no idea. I think that's well above my pay grade.
Yeah, big existential question here, Shiv. But anyway, hey, worth a shot. Let's get to our next question then. Julia's got a question for us. She's saying, in your opinion, how would you treat analysts' predictions regarding stock valuation?
I do not pay attention to what analysts say or the price targets that they give on stocks at all. I could probably leave it there. I don't pay attention to it.
Yeah, I mean, of course, nobody knows the future, but I think what I'm taking away, Daniel, from your reaction there is that you like to do your own research, you like to do your own groundwork. Relying too much on others, it just creates a little bit more doubt, I guess, than maybe you're comfortable with. Is that a fair assessment?
I would say that's fair. I just think also that when you take a look at the historical data, a lot of analyst price targets tend to follow what the stock is currently doing. So if the stock is currently going up, then you'll see a lot of analysts raise their price targets. And if the stock is going down, then you'll see them lower their price targets. So I think that when you take a look at the historical data, it's just not really useful information, in my opinion.
Okay, Daniel's got a question to us. Let's keep this train rolling. Daniel wants to know, what would you look for in an IPO if you ever wanted to invest in one?
Man, these are some great questions. Wow. Okay. IPOs are something that I typically do not look at or care to try and invest in. It's funny because in The Intelligent Investor, it actually says that IPO stands for it's probably overpriced. And this is because before companies do their IPOs, they like to go on something called a roadshow. And the roadshow is them going across the country or going across multiple countries and really trying to just sell investors on their IPO and get them to buy the stock on day one of the IPO. So the IPO is essentially the point of maximum enthusiasm for the business. And therefore, that means that it's probably also the point where it's going to be the most expensive the stock is ever going to be. That's typically why after companies IPO, their share prices perform quite poorly. It's not a 100% correlation. Sometimes companies IPO and their share prices go on to perform well, but on average, businesses' share price after IPOs typically tend to not perform well just because of how much excitement there is on the IPO date.
Yeah, I've looked into some of the IPO performance as well, and I've seen sometimes you see like a big initial spike on that day one with all that enthusiasm, and then after that, sometimes they ain't looking so hot. Again, that's like a general comment, not always the case. But okay, good to get your perspective on that one. Let's get to our next question. What do we have on tap? Ivan has a question. Have you invested in any ETFs?
I mean, technically, I have. If the question is ever in my life, yes, I have invested in ETFs before. I do not currently own any ETFs, though. So as I have grown as an investor and as I have proven to myself that I can pick stocks accurately and outperform over the long term by doing so, I have removed all ETF positions from my personal portfolio. With that being said, I do still believe that for the vast majority of investors, ETFs are an incredible option and probably what people should stick to.
Okay, so you got to have a lot of confidence in your process and in your results here. But hey, a little confidence. I like it, Daniel. I like it. Okay, let's get to our next question. Chef Wheel, I hope I'm saying that right, has a question. What kind of forecast do you have for gold and gold mining stocks? Interesting question, Daniel. If I can jump in, if I will. I know you're not a fan of like cyclical industries like the mining industry. Can you talk us through that?
Yeah, so in general, I have absolutely no idea what the future of gold prices is going to do or what gold mining stocks are going to do. And the reason I do not own any gold miners in my portfolio or any mining companies or commodity companies in my portfolio as a whole is because of that exact point. I have no idea what the price of gold is going to do. It's ran like crazy, so all of these gold miners' profits are going up heavily. But if gold prices, see a correction of 20% over the next few years, which I have no idea if they're going to, then the fundamentals and the profits of these miners look significantly different. So when a business's profits relies on a commodity, and I have no idea on how to predict what that commodity is going to do in the future, then it also means that I have no idea what the profits of that business are going to look like over the long term. And therefore, just for me, as my own person, it makes those investments speculative. And as I said, I try to avoid speculation in my portfolio now.
Okay, we got one last question for you, Daniel. Appreciate you sharing your thoughts on gold, by the way. Pauline has a question. When do you decide it's time to sell? Great question to end things on, Pauline. Daniel, what do you say?
Yeah, so there is a few different reasons that I would sell a position. One is because it gets extremely overvalued, so the price gets too disconnected from its fundamentals on the upside to the point where I think that its future return potential gets quite low. So a stock getting overvalued, well, extremely overvalued, is a reason that I would sell. Another reason that I would sell is if I believe that the investment thesis has changed or the fundamentals of the business are getting weaker. So that's part of the buy and verify strategy that I personally have. So if I own a business and I think that its margins are going down, competition is rising, or a competitor is starting to successfully attack this business and take its market share, then that is a point where maybe I need to reassess my investment thesis and potentially sell the stock if I think that it could get worse. And then, so I think those would be the two big ones.
I love that phrase, buy and verify. I may have to steal that. I will give you credit, though, Daniel, if I do. Appreciate you fielding all those questions for us. Fantastic questions from our viewers today. And really appreciate you sharing your research process as well. We'll have to have you back on again, too. There's so much more we could talk about when it comes to fundamental analysis and all this good stuff. But we appreciate you sharing your perspective with us today.
Yeah, absolutely. It was great chatting, and thank you for having me on.
Absolutely. And for those in our audience, of course, we appreciate you tuning in as always. Make sure you check out next week's episode. We're going to hear how one millennial couple is effectively getting paid to travel the world, thanks in part to their savvy investing strategy. They're going to explain how you can get a taste of the good life by investing in your next micro retirement. It's a fascinating story. You're going to need to hear this one to believe it. So make sure you tune in. That's all the time we have for this week from everyone at Inside Investing. Thank you so much for tuning in. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.